Hey boys, welcome back to the amendments video of your CA final May 2025 examinations. Let's continue from our previous discussion. Yes, in the previous discussion we had some good insights on your basics of income tax, your special tax regime, your PGBP. Yes, we're going to start today with the most important amendments of your syllabus, the amendments relating to your capital gains. Yes, today's lecture is a little more interesting because you have a lot more amendments in capital gains and you are expecting a good amount of questions coming up in capital gains. So please pay attention to this video, and at any appropriate stage, if you get stuck somewhere, feel free to drop in a comment so that I can respond back to it accordingly. Yes, let's kickstart with the discussion on capital gains, people. The first three amendments, which I have to, on a high level, if I have to explain to you, is amendments in three areas. Your area number one, where the critical amendment is on your period of holding. Period of holding has significant amount of amendments which you need to pay attention to. Second is your amendment relating to your tax rates. Now we have already had a bit of a discussion on your tax rates, but this is also a critical amendment. And third is your amendment relating to buyback. So three important topics we are going to be discussing in today's lecture, people, to understand what the critical amendments are. Yes, pay attention with me and see it till the end, you will understand things better. Yes, three amendments we are going to pay focus on attention perspective. Yes, moving on, people, to our amendments. The first is your period of holding. Here is the amendment model. Yes, starting 23rd July, which is the day on which your finance number 2 budget was implemented, income tax has come and notified saying all your period of holdings which were there earlier have been modified as follows. What are the amendments, people? Critically, the items you see in green is the ones which are important. Amendment number 1 is relating to your business trust. Here is where the income tax has made an amendment which says that after 23rd July, the alignment will be same as section 112A. Meaning under 112A, you could have claimed 10% in excess of 1.25 lakhs or 12.5 in excess of 1.25 lakhs for three assets: equity shares, your units of equity oriented funds, and your units of business trust. The problem what was happening is your equity shares and your equity oriented funds had a period of holding of 12 months, whereas for business trust it was 36 months. The mismatch was not making sense, and therefore Nirmala Sitharaman has come and recommended saying, from the current year, your units of business trust will also have a period of holding of only 12 months. Meaning, if it is 12 months or lesser, then it is short term. If it is more than 12 months, then it is long term. Yes. What was the provisions before this? For those who would have already been aware, the limit was 36 months earlier. Until last year, 36 months was the criteria for you to satisfy in order to treat it as a unit of business trust. From current year, it is 12 months. Although, people, please pay attention that the amendments only get into effect from 23rd July, which means if the asset was sold before 23rd July, the old rules will apply of 36 months. Whereas if the asset is sold after 23rd July, then this rules will apply for you to determine whether it is short term or long term. Yes. So these amendments which you're noticing right now, people, is if it is transferred after 23rd July. If you're transferring before 23rd July, what you have in your existing material will hold good, no changes in that. Amendment number 2 is here. Where income tax has now come and notified starting 23rd July, any kind of unlisted bonds or debentures will now always be called as short-term assets. I will not call them as long-term assets itself. Yes, before 23rd July, you could come and check whether it is eligible for 24 months or 36 months. Yes, in order to make it long-term as well. Whereas from 23rd July, amendments come and say that these assets are always short-term assets. Amendment number 3 and the critical amendment is relating to your other capital assets. Until last year, you could claim other capital assets as long-term only when they satisfy 36 months. Current year amendment comes and clarifies we don't have the concept of 36 months anymore. And therefore every asset will be called as long term after 24 months itself. Which means from current year, people, there are technically only two period of holdings. One is called 12 months, one is called 24 months. If it does not fall into 12 months, it falls into 24 months. That is what the logic is. That is what is the amendments of the current year. Again, disclaimer, only happening after sales of 23rd July. If it's happening before 23rd July, then the old provisions will apply. Yes. Now, while I'm telling you all this, people, one blunt, blatant error has happened from income tax. While income tax section 242A, which talks about period of holding, has been modified to say that there is no more concept of 36 months, but there is only one topic called 24 months. Amendments were not made in section 50B. Amendments were not made in section 50B, which dealt with slump sale. Yes. While this looks like a clear mistake from income tax, it has not been corrected. It has not been corrected, and therefore today as we speak, slump sale still remains at 36 months even before 23rd July or after 23rd July. No changes in that. No changes in that. While yes, every other asset has moved from 36 to 24, slump sale is the only miss out which has happened from income tax, and therefore that still remains at 36 months for your exams. For your exams, even ICAI has recognized this mistake, and ICAI has told we will continue with 36 months until further clarifications have been received, and therefore for your exams, slump sale remains at 36 months, while every other asset has moved from 36 to 24 months. Yes, what is the amendment, people? Quickly revising it once again. Units of business trust has moved from 36 months to 12 months. Any other asset has moved from 36 months to 24 months. If they are selling after 23rd July, but if it's an unlisted bond or debenture, going forward, it is always going to be called short-term assets and never going to be called as long-term assets. This is your first critical amendment in respect of your period of holding. Any doubts on this amendments? No? Perfect. Let's move on forward, people. Your amendment number 2. I'm going forward, people. I'm just checking quickly if there is any other amendments which we need to discuss. As such, there is no other amendments, but let me come and clarify this. Amendment number 1, which is your rates of taxes. We will discuss about this amendment as we proceed forward. Yes. Next is your amendment as a clarification here. This is also something which we'll be discussing going forward right now. Yes. What other amendments do we have? I know there is one amendment here. Yes, this is the amendment which we are speaking about right now, people, where from the current year, income tax is notified that any unlisted bonds or debentures which are sold on or after 23rd July will always be called as a short-term asset irrespective of what your period of holding is. I don't care. I am not going to look at what your period of holding is. They will always be called as short-term assets only when they're sold after 23rd July. If they're sold before 23rd July, people, you are free enough to take it as 36 months and consider them as long-term as well. So this is one critical amendment for you. Amendment number 2 is in your 112A. I am quickly going there. Yes, 112A, where is the amendment? Your amendment is here. Yes, where a clarification, people, I would rather not call it as an amendment, but more of a clarification. Income taxes in the current year come and clarified saying if there is any kind of computation of equity shares which were unlisted on 31st January 2018, the year in which 112A was introduced, and has become the property of assessee under an offer for sale to the public included in an IPO. Yes, even if they were unlisted on that day, but they have come later on as an offer for sale in a public IPO, they will still be called as 112A assets. This is more of a clarification given to you, people. Don't expect questions coming around this in exam. Not very important from exam perspective, but more of a clarificatory provisions. Yes. I'm going to take a step back and we're now going to discuss the critical amendment of your tax rates. While we have already dealt with this a little bit in your basics of income tax, I am taking some time and understanding this once again for you people. Amendments are as follows. Income tax has come and clarified for all the assets which were classified as 112A earlier will now be taxable at a rate of 12.5 in excess of 1.25 lakhs. Will now be taxable at 12.5 in excess of 1.25 lakhs when the sales is happening after 23rd July. And the sales is happening after 23rd July. Can someone help me with what were the amendments before this? Yes, the provisions were 10% in excess of 1.25 lakhs. 10% in excess of 1.25 lakhs. We did one good question on this in your basics also, people. If you don't have seen it already, please go back and check that question. This is what the amendment was when it comes to 112A. Coming to 111A, people, the amendment of the current year has increased the rate to 20%, whereas it was earlier 15% before 23rd July. Yes or no? Yes. Focus attention for your exams, people, is the second part. Until 23rd July, people, the provisions used to come and say that you can have a 112 asset. Which you tax at the rate of 20%. From the current year, income tax is notified saying if the asset is sold after 23rd July, you will tax it at the rate of 12.5% on on all assets. You will tax it at the rate of 12.5% on all assets, with a condition saying that because you're taxing it at a lower rate compared to what you did earlier, you are no more eligible for something called as indexation. You are no more eligible for something called as indexation. So the amendments of the current year are twofold, people. Fold number one comes and says amendment is that the rate of tax has dropped down from 20% to 12.5% for all your 112 assets. But because it is dropped down to 12.5%, income tax comes and clarifies you will no more be eligible for any indexation benefits on your cost of acquisition or your cost of improvement. That is what was there in the format, people. The format now comes and says if the asset is transferred before 23rd July, you will get indexations. But if an asset is transferred after 23rd July, you will get no indexations. Yes. While this is what was introduced, people, after the finance bill was going to become a finance act, there were a lot of human cry on this. People were not happy with the fact that indexation was removed because a lot of people were saving a lot of taxes based on indexation. And therefore, a small proposal was made to Nirmala ma'am that we want introduction of indexation back for real estate. Hearing everyone, people, Nirmala ma'am came up with a proposal. The proposal was as follows. Nirmala ma'am came and said, I am not going to delete no indexation rules. I am not going to delete no indexation rules, but I'll give you an additional option. If you find out that you are a resident individual or HUF, who has bought the asset before 23rd July, I don't really care because, if you have bought the asset before 23rd July and you have sold it before 23rd July, then there is no problem here, people. Yes, because asset itself is transferred before the amendments came into picture. Your tax rate will be 20% and you will be eligible for indexations. No change in the rules. Yes or no? Yes. Nirmala ma'am came and said, if you have bought after 23rd July, it is very obvious that you're going to sell after 23rd July as well. Yes, in that case, people, everything is aware to you that it is based on the new rules. Therefore, nothing can be changed here. You will be taxed at the rate of 12.5%, which is without indexation. With me till here? Yes, amendment is here, and this is what I expect in exam also. The most important thing, when Nirmala ma'am came and said, if you have bought it before 23rd July, but you have sold it after 23rd July, Nirmala ma'am came and said, boss, when you bought it, you thought you will get indexation. But unfortunately, with the amendments coming in right now, no indexation has been granted to you. I am hereby giving you an option. The option is as follows. Tell me what would be your tax payable if you do 20% with indexation. Tell me what will be your tax payable if you do 20% with indexation, and then tell me what will be your tax if you do 12.5% without indexation. Yes, basically I'm telling you, had you not gone with the new provisions, what would have been your capital gains and what is the tax on this? And if you go by the new provisions, what would have been the capital gains and what would be the tax? You are free to pay whichever is lower. To the India. Don't pay excess. Three critical things for you to know before I go forward, people. Critical point number one. This is only applicable for resident individuals and HUF. No other assessee has this benefit. Critical amendment number two. This is only applicable on immovable property. People, any other properties, even if you were eligible for indexation and that would have given you a lower tax rate, income tax does not care. Income tax comes and says you can only do it on real estate, not for anything else. It was a very restricted benefit granted by Nirmala ma'am on this stage. And rule number three, this is only for paying lower taxes. Nowhere has your income changed. Nowhere. As your income changed, your income will remain as per new regime. Your income will remain as per new regime. Your income will not change. It will remain as per new regime. For the limited purpose of computing tax, you will check whichever is lower. Whichever is lower. What does it mean, Rahul? Take a simple example. If I am coming and telling I have an asset which I have today sold for 100, which I have today sold for 100, which I purchased for 90, which I purchased for 90. People, as per the new rule, what will you do? You'll take the full value of consideration as 100, you'll take the cost of acquisition without indexation as 90, and you will get the number as 10. This will be your long-term capital gains. Yes or no? Because you're doing it as per new, you will tax it at the rate of 12.5%, which will end up giving you 1.25. Yes, I'm ignoring cess and everything, people, for the limited purpose of the discussion. If you had done it as per old, you would have sold it for 100, no change here. But assuming after indexation, number would have become 106. People, you will ideally arrive at a 6 rupees ka loss. Agreed, not agreed? Yes. Now, if you understand, you have taken indexation benefit, so you have to tax at the rate of 20%. Luckily, because the income is a loss, tax also becomes zero. Here is where income tax would say, choose whichever is lower. So take it either as 1.25 or 0, whichever is lower. Therefore, my current year tax becomes 0. Here is the question. Forget the tax. I'm not paying anything. But had I got indexation benefit, I would have got a -6. Can I use this loss against my other incomes? Can I carry forward these losses? Can I do something with the losses? No, and no. You cannot do anything with the losses, people. Your computation is as per this only. Because you have sold the asset after 23rd July. You are ideally not eligible for indexations. But to ensure that you don't pay more taxes, I'm giving you a check mechanism. Based on which I'm asking you to pay nothing. This does not mean that you can treat your indexation rule as the applicable income. That will not happen. Your income for the purpose of your table will remain as 10. The tax alone will come down to 0 because your old regime would give you a better benefits. This is what the new amendment is. Just for the sake of doing it better, people, let's do one thing. Let's look at a real life question to understand how does this operate. Yes, I'm doing this question along with you, people. While you might run this question in your past exams also, I'm doing it so that you understand things better. Yes, look at the question, people. A complete capital gain level question. The question says, Mr. Sham has purchased the house property on 15th February 1979 for 3,24,000. In addition, he has also paid stamp duty charges on the stamp value of 3,50,000. Yes, so which means they've given you the cost of acquisition, people. You have a cost of acquisition which is 3,24,000. But because you also paid stamp duty charges, you can claim that extra stamp duty charges also, which is 35,000. Total becomes 3,59,000. This is your actual cost of acquisition. Although yes, people, for those who have already done the syllabus would be aware, because the asset is bought before 2001, you can claim the FMV or STV, whichever is lower, as on 2001 if it is found to be more beneficial. Let's come to that part. In April 2008, Mr. Sham has entered into an agreement with Mr. Mohan for selling such property for 14,35,000 and has received an amount of 1,11,000 rupees as advance. However, for the sale consideration did not materialize, Sham has forfeited this advance. People, now you have an advance forfeiture which is happening before 2014. Income tax says any time of advance forfeiture which you have, you will have to reduce it from the cost of the acquisition. Therefore, I am planning to reduce 1,11,000 from my advance forfeiture. Yes, next. In May 2015, he has again entered into an agreement for the sale of said house for 20,25,000 to Mrs. Deepshika and has received 1,51,000 as advance. However, Deepshika did not pay the balance amount and Sham has decided to forfeit this advance. People, now the advance forfeiture is happening after 23rd July, after 2014, and therefore I do not care. This whole logic does not matter to me. Because you would have actually ideally already taxed this under the head IFOS in 2015 itself. I am not bothered. Yes, next. On August 2015, Sham has decided to construct the first floor of the property by incurring 3,90,000. This now becomes my cost of improvement. I have 3,90,000 ka cost of improvement. Yes, people, with me till here? Great. On 15th November 2024, which is your previous year, Sham has entered into an agreement with Manish for sale of such house on 30,50,000 rupees and has received 1,50,000 as advance through account paid check. Mr. Manish paid the balance entire sum and Sham has transferred the house to Mr. Manish on February 20, 2025. Sham has paid the brokerages on first 1% of the sale consideration to the broker. Notice carefully, people. I bought the asset before 23rd July. Yes, but I am planning to sell the asset on 20 February 2025, which means purchase is before and sale is after. Here is when Nirmala ma'am will come and say you can do tax whichever is lower. Tax whichever is lower. But I know what is my sale price, people. My sale price is 30,50,000. So my full value of consideration has come to 30,50,000. 30,50,000, and my transfer expenses have been notified as 1% of the sale consideration, which should be 30,500 rupees. Yes, on 1st April 2001, people, they've given you the fair market value of the property as 11,85,000 and stamp duty is given as 10,70,000. Yes, now this is what the fair market values have been given. People, because the asset is purchased before 2001, you can take lower of FMV or STV. You can take lower of FMV or STV, lower of FMV or SDV, people, which will become 10,70,000. This will be compared with the actual cost, whichever is higher. If I look at my cost of acquisition, this 3,90,000. Whichever is higher would become 10,70,000. So I'm ignoring my cost of acquisition completely, people. My cost of acquisition of 3,59,000 is completely ignored, and I'm taking my actual cost of acquisition as 10,70,000. Yes, because I have an advance forfeiture, I will do an advance forfeiture also, which is 1,11,000. Giving me a revised cost of acquisition as how much, people? Help me. 10,70. 10,70,000 minus 1,11,000 will give you 9,60,000. This is my actual cost of acquisition for the purpose of capital gains. Further, the valuation authority on 15th November has told it as 39 lakhs, whereas on 20th February has told it as 41 lakhs. People, when two stamp duty values are given to you, income tax says you will take the stamp duty on the date of agreement if it is paid by permissible modes as an advance. If it is paid advance by permissible modes, you have received advance of 1,50,000, that too through account paycheck, which means you can take the stamp duty value on the date of transfer. On the date of my transfer, people, it is 39 lakhs. My stamp duty value is 39 lakhs. My full value of consideration is 30,50,000. Provisions of income tax say, as per section 50C, you have to take whichever is higher. Therefore, 39 lakhs becomes your answer, people. You would have taken the full value of consideration as actual consideration if it was within 110%, which is not happening. If you take 30,50,000 ka 110%, it will not come within 39 lakhs, and therefore you will take the full value of consideration as 39 lakhs. Compute the capital gains in the hands of Shams. They are also computing the capital gains, assuming tax on capital gains, assuming the basic exemption limit has been fully exhausted against other incomes. Yes or no? Yes. Now this is what the question looks like, people. I have all my facts in my hand. Let's quickly do the sum and see what the answer comes to. Yes, if I have to put out my facts properly, people, I am cleaning out the format. Yes, for those who remember the format with capital gains, will do it along with me. What is the format, people? You will start with full value of consideration. We just now found out my full value of consideration will be 39 lakhs. I have some transfer expenses. Yes, I have some transfer expenses of 30,500 rupees. Therefore, my net consideration is how much, people? Help me out here. How much is my net consideration? I am doing 39 lakhs minus 30,500, which will give me 38,69,500. Yes. Now, I have to remove my cost of acquisition and my cost of improvement. Please understand, people, because the question says that the transfer is happening on 20th February 25, which is after 23rd July, you are not eligible for any indexation benefits. For getting indexation benefits, people, my cost of acquisition is 9,60,000. My cost of improvement has been given as 3,90,000. Yes, with nothing else pending, we can find out what my capital gains looks like. My capital gains will be minus 9,60,000 minus 3,90,000, which will give me 25,19,500 rupees. 25,19,500 rupees. Yes, this would be my long-term capital gains under section 112. Notice carefully, people, this is my computation as per 23rd July later model, which means as per the new model. Because I have not claimed indexation, this 25,19,000 will be taxable at the rate of 12.5%. Will be taxable at the rate of 12.5%, which means it will be taxable for a percentage of 314,938. I got 37.5, but I'm rounding it off. Now, ideally, you would come and say this is what you're supposed to pay tax on. Agreed, not agreed? No. Income tax says because you bought the asset before 23rd July and are selling it after 23rd July, you are a resident individual in HUF, you have bought an immovable property, you are also eligible to check how would your tax look like if you have done it as per old regime. People, no changes in my net consideration, therefore 38,69,500 remains the same. Whereas problem comes with your cost of acquisition and cost of improvement. Because you have a cost of acquisition of an asset which is purchased before 2001, you can do indexation of 9,60,000 into 363, which is the inflation rate of current year, divided by 100. Help me out, people. How much is the number? 9,60,000 into 363 divided by 100, which gives me 34,84,800. 34,84,800. On the similar terms, because it is cost of improvement can also be eligible for indexations into 363 divided by, let's check when did we do the improvement, people. We did the improvement on August 2015. My inflation rates of 2015-16 is given as 254. So I'm going to do an inflation benefit of 254, people, which is 363 divided by 254. Yes, what is my cost? My cost is 3,90,000. Help me here again quickly. Yes, 3,90,000 into 363 divided by 254, which will give me 3,90,000 into 363 divided by 254. Yes, I am getting 557362. 557362. Yes, with my net considerations and my cost of acquisitions and all given, people, I can notice right out of the bat that I am getting a loss. How much loss am I getting? 38,69,500 minus 34,84,800 minus 557362. I am getting a loss of 315,358. 38,69,500 minus 34,84,800 minus 557362. I'm getting so I am getting a loss of 172662. I'm getting a loss of 1,72,662. People, now because I've claimed indexation, I'll have to tax it at the higher rate of 20%. But luckily for me, in this question, my tax is zero. Here is a case where income tax will say, in your new tax regime, you are paying 12.5 pay 3,14,938. Old would ask you to pay 0 and therefore take whichever is lower. Therefore, your final tax payable is 0. Yes. Now, here is the question. Although my final tax payable is 0, can I take this loss of 1,72,662 and can I set off against my other incomes? Can I claim it as a deduction in the future years and all? No. People, this has no relevance in your computation. This only helps you to determine what your tax liability is. You will not get this benefit anywhere. You will not get this benefit anywhere. For all practical purposes, your total income is 25,19,500 from capital gains perspective. While your tax may have become zero, for the purpose of your computation, you will take it as 25,19,500. No changes here. No changes here. This is the amendment of current year, people. Very, very, very important amendment of your current year. Please pay attention to this. Please pay attention to this. Yes, if I have to show you what the ICA template looks like, ICA template would do the same thing. They would have done the whole computation, people, arrived at your long-term capital gains of 25,20,500 rupees. Then they would have come and told you what the tax rate on this is, which is 315063. Your LTCG with indexation benefits is giving you 1,69,032 as a loss. Maybe some decimal differences, people, let's not worry about it. Yes, if you notice, loss is showing in my old model, profit is showing in my new model. You will pay no tax. You will pay no tax. They would come and say, since the computation results in a long-term capital loss, if indexation is benefit is given, the tax on 112 would be nil. However, this computation is only for determining tax liability, and the said loss can neither be set off nor be carried forward. The said loss can neither be set off nor be carried forward. This is what the provision says. Yes, so you cannot claim anything in that old model because you have sold the asset after 23rd July. If this question would have come and told you that the sale is happening before 23rd July, then you would have not even done the new model. You would have done it as per the old model, and you would have got the loss of 1,69,000 for you to claim, carry forward, and set off as well. Yes, all those would have happened. The only problem happened is because you did it post 23rd July, income tax stops by saying no indexation benefits to you, no tax benefits to you on your old models. Yes, this is the amendment of current year, people. The very, very critical amendment of your capital gains, which comes and says, if you have an asset which is land and building, which is sold by a residential individual or HUF, if it is acquired before 23rd July, you will do tax at the rate of 20% with indexation, 12.5% without indexation, and take whichever is lower. If it is any other person or if it is any other assessee, the rate will become 12.5% without indexations alone. For this one, people, please pay attention. This is only for tax purposes, not for income purposes. For income purposes, it will be as per the new model only. It is only for tax purposes that you're doing whichever is lower. Clear? Yes. Spend some time on this amendment once again, people. There are some hefty amount of questions in my question bank as well as study material also. Please do those questions, solve it from your end, and see how you understand this carefully. Please pay very important attention to this topic. My expectation, this will come in exam. If not final, maybe it enter, but will definitely come for your exam, because this is only 1 year they can test it properly. From next year, it is not very critical to test and all. This year is what is being tested on this properly. So expect a question around this, and more so because, people, this will not be given in exam. Nowhere in the exam are they going to come and tell you to do tax as per old and new and tell whichever is lower. They will simply come and say do tax. It is your job to come and figure out that yes, I have to do it at whichever is lower and do whichever is beneficial. Yes or no? Yes. Amendment number 1, critical amendment. Yes, this leaves me with the last amendment for your topic, people, which talks about your buyback. I'm taking you quickly to your buyback amendments, people. What is the buyback amendment? The buyback amendment is as follows. From current year, income tax has notified that buyback will not be the same rules as what was earlier. What was the rules earlier, people? You would have learnt it in your syllabus, or for those people who were part of November syllabus would have learnt it in your syllabus, that buybacks were actually liable for something called buyback tax. This provisions have been modified. Yes, up to 30th September 2024. Notice the dates very carefully. Income tax says up to 30th September 2024. If a buyback takes place, income tax says the company will pay something called buyback tax. At what rates, Rahul? They will pay it at the rate of 20% plus 12% surcharge plus 4% cess, which will give you 23.296%. 23.296%. This is what the company will pay as buyback tax. The shareholder becomes fully exempt. The shareholder becomes fully exempt. This is what were the provisions until last year. Until last year, if you make the buyback before 30th September, starting 1st October, people, income tax came up with a very weird proposal. The proposal comes and says, whenever a buyback takes place, two things happen, people. You will surrender your shares and they will give you money. Take an example, people, where what happened is I was having 40 shares in my hand, which I had paid 100 rupees each. They would have come and told my cost of acquisition is 4,000 rupees. Now, company has come to me and told they will buy my whole 40 shares. and give me 120 rupees each. Which means they're ready to give me 4,800 rupees. Before 1st October, what you would have done? You would have taken the difference of these two. The difference of these two being 800 rupees. On that 800 rupees, you will do 23.296 and you will close the matter off. Because company will pay it, shareholder becomes exempt. In the current year, income tax says that do one thing. The buyback price which you have will be deemed as dividends. Under section 222. A new subclause F has been introduced where they have come and clarified saying any person who receives buyback money, the whole of the money will be treated as deemed dividend in his hands under section 222F. Which means if Rahul has received 4,800 rupees, the full 4,800 rupees will be taxable in the hands of Rahul. Under the head IFOS. Now, Rahul is feeling a little bad. Rahul is saying, I understand you want to tax this 4,800, I don't mind. But if you're doing that, the 4,000 rupees should have been given to me as deduction. Correct, not correct? Yes or no? Because I paid 4,000 rupees from my pocket, in exchange of which I got 4,800 rupees. So I made a profit of 800 rupees technically. So you should have given me the balance 4,000 as a deduction. Correct, not correct? No. Income tax has come with a very weird proposal where income tax has proposed that the buyback price will be taxed under the head IFOS. Whereas the cost of acquisition will remain under capital gains. Meaning income tax for the first time is coming and saying whatever is the cost which you have, treat it as long-term capital loss or short-term capital loss depending on the nature of the asset. You directly treat that cost of acquisition as a loss which you can carry forward and set off against other capital gains. Meaning same shares, people, sale price will be taxed under IFOS, cost price will become a loss for you to set off against other heads. If I put it out in an example format, people, take an example. If I give you a question where it says Mr. A has 5,000 shares. Bought at a price of, let's say, maybe 20 rupees. Bought at a price of 20 rupees per share. Maybe in 2016. In 2024. Assuming after 23rd July. The company proposes to buy back, let's say, 3,000 shares at a price of rupees 25 per share. Discuss the tax treatment. discuss the tax treatment. Now, if you notice people, while I may have 5,000 shares, the transaction is only dealing with 3,000 shares. So I'm going to ignore the balance 2,000. I'm not really bothered. Yes, look at it from the 3,000 shares perspective. In my 3,000 shares, what and all exactly happened? I bought the shares first in 2016. In 2016, at what price? I bought 3,000 shares at a price of 20, which means I technically paid 60,000. I technically paid 60,000. Today, I have received the buyback price on this. I have received the buyback price on this in 2024, which I have received 25. So it will become 75,000. 75,000. Income tax will say, take this 75,000 and put it under the head IFRS for Mr. A. Fully taxable. Fully taxable. This 60,000 rupees will become long-term capital loss for Mr. A directly. For Mr. A directly. Yes or no? Yes or no? Yes. What the hell should I do with the 60,000 rupees? Income tax will say, wait, if when you have long-term capital gains, wait, when you have long-term capital gains, you can set off. Imagine in this question, I would have come and told you that the balance 2,000 rupees shares, the balance 2,000 ka shares, A proposes to sell at a price of 30 per share. A proposes to sell at a price of 30 per share. Now notice people, because A is selling, it is not a buyback. It is not a buyback. What will you do? You will do normal long-term computation. Full value of consideration. You bought the shares and sold it for 30 rupees, which means you got a full value of consideration of 60,000 rupees. Yes, which is nothing but 2,000 shares into 30 rupees per share. Into 30 rupees per share. Because I've sold this asset after 23rd July, people, no question of indexation and also forget indexation. 2,000 ka shares I bought for 20 rupees, which means I have 40,000 rupees ka cost of acquisition. My capital gains becomes 20,000 rupees. My capital gains becomes 20,000 rupees. At this stage, I will say I have a loss of 60,000 rupees. So therefore, I will set off the loss to the extent of 20,000 rupees and I will not pay tax on this. I will not pay tax on this. The remaining 40,000 rupees will get carried forward. The remaining 40,000 rupees will be remaining carried forward for a period of 8 assessment years if you file your returns properly. If you file your returns properly. If you technically notice, the whole model does not make sense. The whole model does not make sense. You know that you had a profit of only the differential 15,000. So you should have ideally only had to tax 15,000. But here is a case where you're taxing the whole 75,000 as IFRS income. And this 60,000 rupees, you're not struggling to set off against future losses, future incomes. Against future incomes. But this is what the new proposal is, people. The new proposal comes and says you have to tax the whole buyback price as dividends in the hands of shareholder. Whatever is the cost of acquisition, you can claim it as losses. You can claim it as losses. Two critical things for this, people. Critical point number one. Critical point number one. The buyback price is fully taxable. The buyback price is fully taxable as IFRS. As IFRS. What do I mean by this, people? In your dividends chapter, I'm not sure if everyone is aware about it, but dividends chapter would normally come and say that you can only tax dividends to the extent of accumulated profits. To the extent of accumulated profits. Unfortunately for this, they did not notify anything. They did not notify anything. They have come and said it is whether profit or not. Whether profit or not, which means if a question comes in exam where the question comes and says the company has no reserve and surplus itself and still they propose for a buyback, this is the only section where you will still tax it as dividends. You will still tax it as dividends even though you have no profits. Even though you have no profits, because this section they did not mention the word accumulated profits. They did not mention the word accumulated profits. So your 222 A, B, C, D, E all mention the fact that you can only tax something as dividends to the extent of accumulated profits. For this one, there is no accumulated profits and therefore this would be fully taxable even if the company makes any losses. Even if the company makes any losses. Critical point number two, buyback price does not get any deductions. Does not get any deductions. Yes, people, normally in your dividends chapter, you would have learned the fact that you are not eligible to claim any expenses except for one expense, which is called interest on loan. which is called interest on loan, which you are eligible to claim against your dividends, people, subject to an overall restriction of 20% of your dividend income. Subject to an overall restriction of 20% of your dividend income. For this one, they have clarified that also is not eligible. That also is not eligible. You have to fully tax this number. So the 75,000 will be taxable no matter what reason it is. No matter what reason it is. Even if the company makes losses, you have to tax 75,000. Even if you have some expenses against this, you will ignore all the expenses and you will tax 75,000. No deductions for anything whatsoever. For anything whatsoever. So this is like a blanket tax. This is like a blanket tax, no rules, no restrictions, nothing. Tax 75,000, fully tax it off. Yes, that is what is the rule of buyback, people. Yes, you expect questions on this also in exam, people, because it has moved to a different chapter itself called IFOS. Please pay attention to it. Yes, any kind of distribution of consideration to shareholders of the company on buyback shall be treated as dividends under section 222F in the hands of shareholders, irrespective of the profits in the company. Irrespective of the profits in the company, no expenses of any nature can be claimed against such buyback dividends. The consideration for the purpose of capital gains will be treated as nil, and accordingly the whole cost of acquisition of the shares will now be treated as a capital loss in the hands of shareholders. In simple words, whatever buyback you have, the consideration value will be fully taxed under the head IFOS for the shareholders, and whatever cost you have, you will treat it as long-term or short-term capital loss in the hands of shareholders to be carried forward for the respective 8 years and to be set off accordingly. This is what the whole computation of buyback looks like. Clear? Yes. Two critical amendments for you people. Period. Your 112 ka immobile property, and second is your buyback. I have personal opinions and these will definitely come for your exam, so please pay attention to it. We have done some sums. If you want, please pause, rewind and check back those sums once again to understand this better, but pay attention to it. If you don't understand it, reach out to me and we'll discuss it once again. Yes, this is your critical amendments when it comes to capital gains, people. Other than that, you have no amendments in capital gains, no amendments in IFOS, so therefore IFOS is good enough to go. You definitely have no amendments relating to your other chapters as of now. So no amendments in dividends except for the one which we discussed just now, people. Dividends 222F comes and clarifies any payment against the buyback of its own shares will now be taxable as deemed dividends whether or not there is accumulated profits. Yes, and the next which we discussed right now, people, the provisions of claiming deductions of interest on loan will not be applicable on buyback dividends. No expenses against your buyback dividends. This is only amendments in dividends. You don't have any other amendments. No amendments in your bond washing or bonus stripping provisions. No amendments in clubbing. You have no amendments in your set off chapter as well. Yes, you have no amendments in your exemptions chapter as well. 14A remains the same. Chapter 6A, there is only one amendment which you have to pay attention to, which we already discussed earlier, people, where we said about the fact that when you're going to have a person who's opting for default tax regime, if a person is opting for default tax regime in case of an individual's, if he makes a contribution to 80CCD pension scheme, then employer's piece of the contribution can now be claimed for 14% of the salary. Whereas if you are under alternate regime, then you will claim 10% of salary. So alternate regime 10%, default regime 14%. Big discussions happen on this in part number 1, people. Refer it once again if you want to understand this better. Yes, other than that, there is no amendments in your chapter 6A. There is one small information addition where they have commented it is not National Sports Fund right now in category A. It is National Sports Development Fund in category A. Not important as such. Ignore it off. Yes, your chapter 6A gets over. Second amendment, people, which I am noticing in chapter 6A is more of an extension of timelines. This was the only amendment which was introduced in your Finance Original Act 2024. Finance Original Act 2024, where they came and clarified that in case of a new startup, the due date has been extended to 31st March 25. Your books would have had it 31st March 24 if you are from November syllabus. Yes, so 24 has now become 25. Nothing else. Due dates have been extended. Don't worry about it. Yes, next. No amendments in your chapter 6A other than that. Your 10AA remains the same. One thing, people, while it's not an amendment, I just want to clarify from current year, people, please pay attention that your due dates have got lapsed. Yes, you normally in 10AA would have read that for the first 5 assessment years you can claim 100%, and next 5 assessment years becomes 50%, and then you get 50% Karul. Yes, until last year people, ICA would ask you questions where you will normally see 10AA eligible for first 100% itself. Yes, but from current year people, the due dates have been lapsed. You could have only created an SEZ entity till FY 1920. So if you create it as latest as FY 1920, this year becomes the 6th year. Check 1920, 2021, 21, 22, 22, 23, 23, 24, and 24, 25. This is your 6th year of your 10AA. This is the 6th year of your 10AA, which means from current year, you will never have 100% of export profits. You can ideally choose to ignore this whole piece itself. You can ideally choose to ignore this whole piece itself. You will never have 100% of export profit model. From current year, if at all a question gets asked in 10AA, it will only be 50% of export profits. It will only be 50% of export profits. So pay attention to that. Pay attention to that. Please be mindful of this. Yes, while it's not an amendment, I just want to clarify this is more of a sunset clause. No amendments in your MAT computations, people. MAT computations remain the same. You have no amendments in your AMT provisions as well. Yes, and yes, we are moving on to the next chapter of amendment, people. We are looking at what is called as assessment of firms. Assessment of firms. Only one amendment in this is the change of book profits. Until last year, people, for those who would have remembered, book profit provisions used to come and say that when you want to pay salary to your partners, the provisions of salary can only be paid by using the book profit of the firm. And the provisions were for the first 3 lakh rupees, you could pay 90% or 1 lakh 50. 90% or 1 lakh 50, and for the balance, you could pay 60%. For the balance, you can pay 60%. From the current year, the provisions have been modified, and the provisions come and say the numbers have been doubled. The numbers have been doubled. Instead of first 3 lakhs, now it is first 6 lakhs. For the first 6 lakhs, you are eligible to pay 90% of your salary, 90% of the book profits, or 3 lakh rupees, whichever is higher. This is me giving little bit of an extra benefit to the partners to earn more salary. So for the first 6 lakh rupees, people, you can now withdraw up to 5,40,000 rupees of salary. 5,40,000 rupees of salary. And if you are making a loss, no problem. You can still withdraw 3 lakh rupees. So one small change in the book profits, your numbers have doubled. Other than that, no changes in the provisions, people. More critical if you are doing PGBP related questions of partnership firm. Yes, no changes in your AOP BOI provisions. And with this, I'm actually going to stop. We're going to come back with the balance topics, people, the non-profit organization, charitable organization, and some other related provisions. We'll come back in the next video, people. I think for this video, we've already spent 50 minutes heavily discussing capital gains and everything, which you should be paying attention to. Yes, so go back, read this once again, make some suitable markings, understand this provision. If you want, solve a little more sums and see how you get comfortable too. But please ensure that those two critical amendments of 112 and your buyback have been focused upon, because you will get exams on this in your May exams. Yes, this is me giving you secret tips on how you should be answering your exams and be strategically preparing for your syllabus so that you definitely get cleared in your CA final May 2025 exams. Yes, on that happy note, people, I'm going to leave you today, and I'm going to come back with another video discussing on the balance amendments which you have in the topic. We will soon be starting with the revision videos also, but this is something which I want to pay more attention to so that you can first complete your syllabus and then you can go to doing revisions of the same. Yes, let me close with this, people. I will catch you up very soon. Until then, take care. Bye bye.